All right, check, check. Let's go ahead and get a sound check. Make sure you guys can hear me and see the screen. Seems like I'm running just a little behind today. I had an appointment earlier and it kind of took longer than I thought it would. So I didn't get the book written all the way, didn't get it published. We're going to have to just go through what I wrote today. And when I finish writing it later in the afternoon, I will get it uploaded into the regular book spot so that you guys can download it. Still need that audio check though to make sure everything is working right. Hey, Gil, how you doing? All right, thank you, thank you. So I decided this week that it would be a good idea to review a little bit about what is on the options chain. I know it may seem a little silly to go in and actually talk about, the options tab, especially when there's so many different brokers, but there's a lot of information in there. And this is the introduction to options. So it kind of seems appropriate. I took this screenshot. I figured we would talk first about what is showing on the underlying. And a lot of brokers do this, even if it doesn't exactly look like Thinkorswim's. But when you're in the options tab, they show you where the dividend date is. And as an options trader, it's real important to be able to recognize that we're in a dividend environment. For you day traders, maybe it's not such a big deal. But when we're in a swing trade, that can be the difference between an increased risk and a decreased risk of assignment. It can also be the difference between taking a winning trade and taking a losing trade. There's a lot of reasons that dividends can affect us. And one of those reasons comes down to the fact that a company is literally giving away money. And if they publish something right before their dividend suggesting that they're going to give away more than investors thought they were going to give away, it changes everything. And then there are people who trade companies because it has dividends. And if a company posts that they're going to decrease the cost of the dividend or the payout, that can really upset investors and they'll bail. They can say that they're going to increase the dividends and you may have more people piling in than before, and that can cause the stock to rise. And depending on which direction your trade is, whether you're long or short, it can literally change the entire direction of the stock price and cause you to lose. One of the rules that I have in my own trading strategies is to check the dividend. Is the trade that I'm going to take fitting inside the window where there is expected to be a dividend payment? And if I see that, most of the time I'll decide not to take the trade because I want to decrease my risk exposure. There's nothing that says we're going to lose a trade just because there's a dividend during our time frame. But the idea is in trading, even when we get a really good trade setup and every signal is telling us to take the trade, if we recognize that we're in a higher risk environment, it can be the decision to go ahead and avoid that trade or to decrease our risk in that environment. So now you know where to find the dividend date. Some companies do dividends every month. Some do them quarterly, and some don't do them at all. So it doesn't hurt to just take a moment, look up there, and see if there's going to be a dividend. Now, I have done videos that are on the bullish bears that explains dividend and assignment. And in this book earlier, we've talked about how as an options buyer, we have rights that we can exercise. So when we sell an option, we're giving somebody the power or the right to exercise an option against us. That's when we would be on the losing end of that, or on the uncomfortable side of it. We're always at risk of assignment. Anytime you sell an option, you're at risk of assignment. That risk is really low. Honestly, it's a rare thing to happen. And even having said that, we can really avoid it most of the time by making sure we don't do things that increase our risk of assignment. Like if you're in a put spread and your trade goes deep into the money, you've increased your risk of assignment a lot, right? That would be one of those times where you would want to make some serious adjustments to that trade to decrease that risk of assignment. When it comes to dividends, it's the calls that have an elevated risk of assignment. And really, it's only the calls in the last week. You know, if we've got a trade on for December and there's going to be a dividend tomorrow, we're not in any risk of assignment in that December call. No problem, no worries. But if I had a trade that was going to expire this Friday and a dividend was tomorrow, I would be in a greater risk of assignment at that point. So knowing where to find the dividend, just to see that number, that date, to know when it's coming out and how much that dividend is important. Another thing that we can do is look at the put call parity. Now, this always kind of screws people up, and it was difficult for me to learn. Put call parity is when you look at the strike that you're in on the call side, and then you match that on the put side. So suppose we're looking at the 146 call here in Apple. The 146 call has a put call parity. On the put side, that option is around $1.24. And on the call side, it's about 201. If the cost of that dividend is near the cost of that put, and that put is the parity to the call that you're in, you're at risk of an assignment in that call coming into dividend. Now, I know it sounds confusing, but just kind of back it up a little bit at a time. If we're in the 146 call, we would look at the cost of the put equal to the 146, right? So the 146 put. And the value of that put, we would then look to see how close it is to the value of that dividend. So if the put was around 20 cents or 22 cents, I would be very concerned about the call that I'm in as we went into that dividend date. Now, obviously, we're not in any, you know, Apple had its dividend in May, and we don't have a dividend coming up yet, so no problem there. But that's another way of recognizing your risk. So remember, it only happens on the short side. If you're buying calls, you won't have any risk of early assignment. And that's because you're the buyer. You choose to exercise your right. So that's for early assignment. If you buy a call and it goes into expiration and it's in the money, you're again at risk of assignment. But early assignment would never happen as a buyer, only as a seller. It's worth noting all the time where the dividend is. And it's worth noting when you see dividend news coming out, when you see that a company reaches aristocrat status or dividend king status, They earn that by carrying that dividend for years and meeting certain criteria. It's not necessarily an elite status. I don't want to make it sound that good, but companies who aim for that status, they have to earn it, and they don't want to lose it. Not very long ago, AT&T, they changed their dividend in a way that wasn't very good from a dividend trader's perspective. And they had worked hard for years to get to the status that they were at, and they just kind of throw it all away. Kind of like thinking about someone who's maybe trying to give up sweets, and they give up sweets for months and months. And then that one day they get a hold of a Reese's peanut butter cup and got to start all over again. That's what happens when those dividend aristocrats and dividend kings, when they break their record, the record starts all over, and they have to start from the beginning. Another thing that's on the options chain is beta. Now, this is something that is really overlooked by a lot of traders. I don't even want to use the word new traders. It's overlooked by a lot of traders. Mainly from the idea that it just seems too good to be true. That we could look at some number and that would give us a really strong perspective of the company that we're looking at and how much it correlates to a benchmark, which is often SPY. I don't want to just assume that it is going to be SPY, but most of the time. And if the platform gives you a chance to set the benchmark to something else, then maybe if you're looking at a lot of technology companies, you would want to use the QQQs for your benchmark. If the broker doesn't give you the choice, that means it's automatically benchmarked against the SPY or the SPX. So on Thinkorswim, they give you a choice between a fast beta and a slow beta, or just beta. The formula for it, or their mindset behind the two different betas, is very similar to something like the EMA and the SMA. Now, if you're really new to trading and you don't quite know the difference between those two moving averages, one of them is set to pay attention to more of the immediate right now environment, while the other one looks at all of the candles in that range. So if you bring up something like a simple moving average, and you compare it with something like an exponential moving average, the exponential moving average is more heavily weighed to the front, while the simple moving average is taking everything equally. So the EMAs are more responsive to sudden changes in market conditions, while the SMAs are slower. It's the same concept with beta. Now, the really neat thing is it lets you choose. So if you're taking very short duration trades and you're doing short-term analysis, maybe Friday or 2 Fridays out, and your time frame for your analysis is very short term, you would be more concerned about a fast beta. You would want to know, how is this company comparing to the overall marketplace, SPY, right now? Not historically, how does this market compare to SPY, right? So to change that setting, you can go to setup. Well, let's do it two ways. I believe you can click on it and change it. At least I thought you could. And then you can go to setup and do it that way. So it's the little configure section, the little gear box there. No, not even there either. All right, well, let's just do it the other way. I know I've changed it from here before. You go to application settings. Do, 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 do. Right here under calculations in general settings, it asks which beta calculation method do you want to use, the standard beta or a fast beta. Now, since I don't really focus on like 2 or 3 year time frames in my trading, I'm more of a shorter duration trader. I keep it set to a fast beta. I promise you, at the end of the day, it's not going to significantly change your overall analysis of the market, right? It's only maybe the bias that it gives you. And this is only one small tool in our analysis, right? It's not like we would jump into a trade just because we see a beta of 1. But now you know where to change that beta value. So I looked up Thinkorswim for a nerd version on what beta means. It's the coefficient measurement of systemic risk of a security's sensitivity of a security's returns to the market returns. Here's the formula for it. The market is defined of having a beta of 1.0. So if the thing that you're looking at is a 1.0 also, then you know that the thing that you're looking at looks very, very similar in price movement to SPY. If it's higher, then it's more volatile than SPY. And if it's lower, then it's less volatile than SPY. The reason that I find a lot of value in that is, well, like over the weekend, we were talking about Apple. There's a really great example. Someone was discussing Apple and said, well, I'm thinking about taking a trade in Apple next week. And I wanted to come in and do some analysis on the Apple chart. And I said, well, make sure while you're analyzing Apple that you also go over and look at the SPY. Because we use the phrase Apple is SPY. SPY is Apple. They're kind of the same thing, right? Apple and SPY, they move very, very similar together. Now, there's times when Apple gets its own news, good, bad, or otherwise, and causes it to change. And then it doesn't move like SPY. It moves based on its own reaction to the marketplace. So when we're thinking about trading in a market, if we know that we can get an indicator, we would want to do that. And one of the best indicators you could ever get is price action. So if I wanted to trade, I don't know, some random market, USO, and I wanted to do an analysis on USO's stock price before I took a trade, if I could look at anything else to get a better understanding of where this could be in a day, a week, a month, I would want to look at it. If I know that this company moves very, very closely to the way that SPY moves, then I know that I can lean more heavily on any kind of SPY analysis out there. And SPY gets in a lot of analysis. Trading firms and institutions and just regular news sites, people look at SPY constantly. But if I'm trading in a market that very rarely moves like SPY, then I want to know that also. so that I don't think that any analysis I've already done on SPY is going to benefit me for the company that I'm about to trade. And now you know where to find that information on the options chain as well. The beta, or the fast beta, sitting in the upper right corner of the options chain. So according to Thinkorswim, this is word for word, securities having a beta greater than 1.0 are more volatile than SPY. I'll just replace market with the word SPY. Securities with lower beta are less volatile than SPY, generally speaking. And you got to remember, the word volatility is a fancy way of saying movement. So if a company has a greater volatility than SPY, that means it typically makes a bigger ATR than SPY. It has an average daily range greater than SPY. And if it's less, then it would be an average daily range less than SPY. We don't want to look at that word volatility and then go to the volatility indicator, right? That's not the kind of volatility that they're talking about. Another reason to look at that is to keep track of where it's at. If you're in a trade, say for January 2022, that's quite a ways out there. You know, you're looking at like 180 something days. Between now and then, if that beta starts to go up or if it starts to go down, then that would tell us something about the market that we're in. Now, this is about as far as I got before I ran out of time. And it's where we can adjust the columns on the options chain to show us all kinds of things. Now, I'm going to have to go through this document later and add the material that we're about to go and look at. So I can't share this document with you now. I'll end up having to put it into the books channel later, and I'll ping you guys when I do it. But for now, we're just going to go right on over to Thinkorswim. And in the upper left corner, we've got this layout drop-down menu. Now, they have some predefined things. You can go in and just set it net change. I like net change percent, but, you know, a little default. And last, it's kind of handy, especially if you're trading in something that's not so liquid, right? Say like Google or Amazon. Those are liquid markets, but they're not as liquid, right? So maybe they're a little slower, and we kind of want to know where the last trade was so that we can kind of get a feel for how much we may want to pay in these options. The theoretical options pricing calculator, or the mark. Think of the word mark as the mid. Where's the middle between the bid and the ask? I don't know why they just didn't make a mid, but, you know, that's the way it goes. So here, when we're looking at something like Google, you can see we've got a really wide bid-ask spread. And that would be our way of trying to determine where's the middle ground here. If I was looking for a trade, how much should I pay for that option? Or what could I sell it for? The really interesting thing is you can go in and start making your own, and you can save those settings so that they are always there and you can go back to them again. This is my Delta setup. If I want to look at Delta, I can just click on that pre-saved setup and I get my Delta, my open interest, my volume, and my implied volatility values. I do like that change percent. And of course, I got my mark so I can catch the mid between the bid and the ask. One of the reasons that I really like Thinkorswim is it lets you save your settings, so that after you do all that work to customize it, if something goes wrong and all those settings get reset, you can reset it back to where you had it. One thing that I found very interesting is that it actually gives you an opportunity to load indicators in there. A long time ago, I had made a watch list column indicator for the TTM squeeze. And the indicators that it lets you load in this options chain are the same indicators that you have in your watch list column. So you can actually load the TTM squeeze right into the options chain and see when these options are getting squeezed. Yeah, I know. That's cool. Or maybe I'm just a nerd, but that's cool. Now it's using a color system, right? So if you're really not familiar with the TTM squeeze, maybe it's gonna, be a little hard for you to kind of catch on. Here's SPY, and we could go in and we can load the TTM squeeze. And this isn't the pro squeeze or anything like that. This is just straight off of Thinkorswim, the TTM squeeze. And now we can see those colors again. And we can see that when it's cyan, the Bollinger Bands have crossed out of the top of the Keltner channels. And when they're blue, it shows that the Bollinger Bands are coming back towards the Keltner channels. If they're red, then the lower band on the Bollinger Bands has broken out of the Keltner channel. And if they're yellow, then those bands are heading back towards the bottom of the Keltner channel. So it's giving you that value, just that visual. And of course, it can be coded. One of the things that I was thinking about changing was this 1.0. That really doesn't tell us very much, but if I could run it into some kind of percentage so that we knew, well, how far has it gone, and then is it still increasing from minute to minute, or is it decreasing minute to minute? That would help out a little bit. But since I don't really treat options that way, I'm more swing trade than day trade options, I never took that time to go ahead and make those adjustments. The idea, though, when you go to customize, is that you can load all kinds of things in there. They won't always work, by the way. You can try something, and whether or not it works, well, you just got to go in and do it and find out. But there are quite a bit of choices in there. And if you're looking to add more choices, you would add choices from the watch list column. That's where those indicators come from. So you would want to go in here and hit customize, and you would want to create a new indicator in your watch list column and then see if it comes up over here. Not all of them even show up. And I don't exactly know why some do show up and some don't show up. All right, so another thing that we have in the options chain is this filter. I tend to use this thing quite a bit when I'm loading up a whole new series of put trades. I do a lot of put credit spreads, and when I set this to filter out the call side, when I open up my options chain, I can put a lot more columns in here and see them clearly because I don't have the calls in my way. I mean, if I'm not using them, I don't need them. I'll get them out of the way. If I know I'm going to be doing a lot of longer term trades, I'll go in there and change what expirations I see. Or the easy way to do it, set a minimum of 30 days. That way, I automatically start near the time frame that I'm interested in trading. It doesn't mean anything in the grand scheme of things if I hide that or not. It just makes things go a little bit quicker, especially when we're often working with limited real estate on the screen size, right? You know, we're trying to see as much as we can, and we don't want to give away extra space if we don't have to. Now, the option statistics, this thing can tell you quite a bit about a market, especially for you day traders. I think it really has a little bit of something for everybody. Now, if you think about unusual options activity, we don't want to just see, you know, any kind of activity. We want the kind of unusual options activity that makes us really stand to attention. Like, damn, that's some options activity. We want it to be something like that. Well, we don't want to have to go in and scroll through the time and sales on every single company we're looking at all day long. It's got to be a faster way than that. Anything traded at the ask or above the ask, that's aggressive. I'm not going to call it unusual options activity because it's not, but it's aggressive. What would be unusual is finding that a large proportion of the trades taken today were hitting at the ask or above the ask. That is unusual options activity. So for an example today, we can see that the calls traded in SPY, 50% of those calls were done at the ask or above the ask. It's telling us that there was a lot of aggressive traders today. They didn't want to wait for the market to fade down to the mid price. They didn't want to haggle or negotiate. They literally walked onto the car lot and said, hey, what's the cost of that vehicle over there? Oh, 50,000. Well, okay, I'm going to buy that. And with no questions asked, just buy it. Now on SPY, that really doesn't harm people all that much. You know what I mean? Because the bid ask is so tight, you're really only going to slip like a penny or two. But if you were going to do that in Google or Amazon or Facebook, you could slip hundreds of dollars trying to get through that marketplace. And still, it shows an aggression for traders to take calls without any negotiation whatsoever. I call it reaching, right? A market doesn't move if we try to get filled at the mid. If we wait and let the market come to us, that's not what moves markets. And when we're looking to take day trades, we want to find a high momentum marketplace. We want to see the aggressive, greedy, repeat trade activity saying that this thing is going to continue to go up. And what makes a market go up is when traders reach past the mid and hit that ask, or when they try to get filled at the ask and it still doesn't fill and they decide, all right, you know what, I'll bump it up a penny. That moves markets. So we can use the trading statistics down here to kind of get a feel for market sentiment. Are people overly aggressive today? Are they, more passive and laid back? If we saw it on the put side, what would that tell us? Are they, trying to get out of those puts aggressively, trying to close down trades that are no longer profitable because, yesterday we were going down and today we're going up? Or are they hammering into those puts really hard, trying to buy a lot of them, right? It would give us some perspective on the trading day. Another number in here is the total trading on the day. Now, you got to kind of get a little bit of context on this number. And one of those contexts comes from how many options in the entire options marketplace are traded in a single day. And then how many options on the one company that you're looking at are traded today. Now, SPY is running, it looks like we're going to hit 4 million contracts today. And that wouldn't necessarily be out of line for SPY, especially since SPY and the SPX combined make up the bulk of all of the options traded in the marketplace. The SPX is really, I feel it's running kind of light today. It doesn't seem like we're getting the trades flow that I would expect to see. I honestly haven't looked at it much this week, yesterday, I should say, and today. This just feels a little light. It's a nice way to say it, I guess. Now, the sizzle is a 5-day average of this options volume. So when we go back and we look at SPY for today, and we ask that question, are we trading above average? Yeah, we're at a 1.3. A 1.0 would say we're at the 5-day average, and anything above a 1.0 would show that we're above the 5-day average volume. So that's one way of doing it. Which side got that index that high up? Well, we can look at the call side and the put side, and we can see that the calls are running 50% higher than their 5-day average. That's pretty aggressive. That's showing a lot of market participation today compared to the last 5 days. But how do the last 5 days stack up to the last month or the last 5 months? Knowing where to find this number is a great spot for you to be able to start taking notes. What was the volume today in SPY? What was it yesterday? What is it going to be tomorrow? And then starting to keep track of that, because if you can get a feel for the options product that you're trading, and you learn that product on a deeper level than the regular person, then you're the smarter person in the room. It does help to be able to find options information. And one of the greatest places to do that is the Options Clearing Corporation. There's the OCC. And they have all kind of benchmarks. They keep track of everything. That's a great place to go. From here, they actually have a daily volume. So you hit the menu on the upper left side. You can go in and you can see the volume for yesterday, the end of day volumes. You can see volume for the month. You can actually gauge ETF volume against equity volumes, futures volumes, all kinds of information, and it's free. And I believe you can log in, set in alerts. They'll give you emails. It's a great resource. A great resource, and all kinds of back testing and benchmarking and tools. So the OCC, and the other one is the OIC. this is another great resource for evaluating the kind of market environment that we're in. And in the last few months, they've done a lot of changes to the options market. They've brought in 3 expirations a week into more products. They've introduced new index products. And those kind of changes, only us nerds are really paying attention. And so it doesn't hit the mass media. It really doesn't get covered in, your normal daily rag newspapers. It just kind of sneaks by and nobody really notices. When you go to places like this on a consistent basis, then you're more in tune of what's going on by the people who regulate, monitor, develop, and put out that kind of content. The third one, of course, would be the CBOE. You can never go wrong with this. Those 3 are your most powerful industry standard resources for information. Nothing else out there is as powerful as these 3. And their amount of data is absolutely endless. Now, you do get the option here on Thinkorswim for this lower section, and you can kind of divide these into different data intervals. When you get a feel for trading options, you'll kind of get to this point where you're aiming for a particular delta value, knowing that, well, I'm going to go out of the money and I'm going to put on a trade 35 days out, and that's kind of my normal spot, and I'm going to do it at a 35 delta. There's these delta numbers that become real popular. Tasty Trades does a lot of videos with delta. Options Alpha does a lot of videos on delta, and they'll use those delta values as some holy grail number of, well, yeah, if you're going to do an iron condor, go out to this delta value. And that drives a lot of newer traders to those values. But it also just becomes a standard when you're developing trade strategies, that you'll maybe start with a lower delta so that you win more often. And then as your theory proves out and you're successful in that trade strategy, you increase your delta value so that you can start making more money until you start losing too often. And then you'll know, okay, well, I've increased it about as much as I can, because if I try to go any more, I'm going to lose more. And then you back it off a little bit, right? You kind of keeping track of them delta values. So it helps to know, well, how much of this overall aggregate volume today was, say, at the extremes, beyond the 80 delta range. How many were in the money? How many were out of the money, right? And this gives you a feel for where we're at. How much of this overall trading was within those ranges. This is the one place where Thinkorswim presents rank, by the way, without you having to go in and do anything. You can get rank in the watch list. You can get it on your charts. It typically requires some form of a custom indicator. But right here is your IV percentile, and that's rank. Now, that really throws people off because they're looking for a word that says rank. And depending on the broker you go to, they may call it rank and then also have another indicator called percentile, making it appear like they're literally 2 different things. Maybe on that particular broker, they are 2 different things. But on Thinkorswim, IV percentile is IV rank. And the reason for that is when Tom Sosnoff was building this platform, it was back in the days when rank wasn't used. It wasn't even a concept. They had to develop that. They had to bring in the language for it and create content to show people and then to teach people how to use that in our trading analysis. When they were first building this platform, they hired a guy and said, see what you can do. And they called it percentile. Now, the language has changed since then. And Tom Sosnoff even said in multiple interviews, it's my fault that it doesn't say rank. He said, by the time we got to that point where we were using the word rank consistently, we had already built this and we just didn't go in and change the word. He said, I really didn't think it mattered that much. Of course, he sold Thinkorswim this platform. And once he did that, it wasn't his concern anymore anyways. And Thinkorswim apparently never decided to change it. And so we still have Ivy percentile. But it's just rank. While we're here, it has the VWAP value. Now, it's worth mentioning that the VWAP is what I would term an institutional indicator. Not from the perspective that institutions use it. That's not really what I mean, although they do use it. It's one of the few things that an institution will actually look at. When I use that phrase, institutional anything, institutional indicator, institutional pivot point, it's the idea that this indicator works for everybody. It won't matter if you're brand new to trading. It won't matter if you're a scalper or a position trader or anything else. If you're looking at a 4-hour chart or a 4-minute chart, your VWAP number is always the same. You can't screw it up. And one of the things that I hear all the time when it comes to indicators, say you put on an RSI or a MACD or a stochastics, usually the first thing that a new trader will ask is, oh, what time frame do I use that RSI? What time frame do I use that MACD? Hey, does that work on a 4-hour? Oh, hey, can I use it on a 15-minute? Well, with this indicator, it doesn't matter. You can use it on any intraday value that you want. It would still be the same number. That makes it institutional. Now, of course, algorithms use it. So the machines will go in and trade off of this number. And that makes it valuable too, especially since we know that it does that. There are so many things that we don't know about when it comes to what the algos do. But this is one that we do know. And it's not even a hypothetical. Like, we know it for a fact. There's hundreds of white papers on this. So knowing where that value is, that's beneficial. Knowing that we can see it without even leaving the options chain. I love it. Where's my price and where's that VWAP? Oh, we're above VWAP. Right? I can just see it at a glance. Where are we at on the day? We're above VWAP. Okay. Right there. So there's a lot of real valuable information here. Now, I often mention to people that when I'm on the options chain, I'm looking at support, resistance, momentum, and trend all right here. Everything you need, it's all there. It takes a little time to get comfortable to begin seeing those things. And a little bit of it is, you know, not having lines and candles, but looking at just numbers. But I promise you, if you spend more time in this options chain, looking at these different values and using these tools, it will get to the point where you start to develop that skill set of having support and resistance and momentum and trend all right here, so that maybe a little chart on the side paired with these numbers would give you a great perspective of what kind of trading day you're dealing with. So below that, we got time and sales. And you can really filter this thing, which I find valuable when I am looking at day trading. I like to go long, not short. So the first thing I do is just turn off the puts. Now, don't let my bias become your bias, right? If you like buying puts and going short in a market that's having a bad day, do that. It's a great trade. Do it. I just don't normally do those. So I weed out the puts and I just show the calls. And then if I'm looking for unusual options activity, I don't want every single strike. I don't want them all. Unusual options should show up within the next 2 weeks. Now for SPY, that means I got to check, quite a few boxes. But if we were looking at Apple, it'd only be 2 boxes I'd need to check, right? Today's the 20th. Next Friday is the 30th. I've got those marked to the 30th. Now the only options that I am looking at are calls between now and next Friday. You can try to weed out the strikes. I don't normally do that. And I believe if you leave the conditions unchecked and yet you check conditions, it won't show spreads, straddles, buy rights, and combos. It will only show you things that aren't that, right? So you're going to see rolls. Those are the yellow. Yellows are rolls. Reds were sells to open, or at least it's seen as a negative trade. And green is buy to open, or it was seen as a positive trade, right? Because you can't have more buyers than sellers. You can't have more sellers than buyers. That's literally the opposite of what the market is doing. But when we see volume, we need to know, well, who initiated the trade? Was it a buyer looking to take possession of something to start a trade? Or was it a person who was looking to sell something to start a trade and he found someone willing to buy it from him, right? Who has the bias? So it color codes it for you. That way, when you do see a call and it's in the red, you know that it was a call that was more than likely sold to open. And if it's a call that's in the green, then more than likely it was bought to open. While we're here looking at this, we can also start to look at what value was the price done at and how close is that value to the market. If it's at the ask or even above the ask, that's very bullish. It's very aggressive. I want to say aggressive, not bullish, because we could have been looking at puts, and puts traded at the ask would still be aggressive, right? Not necessarily bullish. So when we're in here looking at it and we see, well, just right there, we had a block order come through, or a sweep, not a block. That was a sweep. We can see that it took all of those exchanges to get filled. And whoever initiated this trade didn't care where they got it from. They just wanted to get it. They were all done at once. And it went through multiple exchanges to get it done. That's a sweep. And then look at the price. They paid $623 when the market was $622. They reached beyond the ask to get filled. That's how aggressive they were. That's how much they wanted that call. And then, of course, you can filter it out even more. And you can start to knock the quantity down so that you don't get to see the 1, 2, 3s just scrolling by like crazy, right? You can kind of get rid of some of those. Now you got to be a little careful with quantity. if you don't have something else pointing out a sweep for you, because those sweeps, sometimes they're going to be filling 1 or 2 or 3 contracts. These didn't, right? This is all 30, 50, 17, right? But if it was in a smaller product, say Google, the sweep might have been, 3 here and 5 there, and you wouldn't see it at all. It would have just gone right past you and you wouldn't have noticed. So be careful with the filter. You don't want to accidentally filter out something that you need to see. And while you're in here, it shows you the delta value, which again lets you know where the option is. Is it, in the money, at the money, out of the money, just by looking at the delta value. I thought it would let me change the filter for delta, but I guess not. So anyways, you got your filter. And then you have the product depth. Now, really, we're not going to really be able to get deep into this yet, mainly because it's the introduction to options class, and this is going to go into a lot of the Greeks that we haven't covered yet. But one of the good things about using this is, especially for a day trader, being able to go in and look at, maybe just a couple of series, especially on SPY. We can do the same 30 that we were looking at in the time and sales, and we can start looking for that volatility smile. There's a really good article on the ticker tape about volatility smile, and I covered it in the volatility school. So you can kind of refer back to that. I like to typically set this thing just 1 or 2, and then I do all, and I do both sides, the average. I don't go in and just do the calls or the puts, because really when you're dealing with volatility, you kind of need the perspective of both sides. And that's the options chain. Of course, each broker is going to be different, but most of your main brokers are going to be trying to present most of this material somewhere on that screen. And I have a lot of brokers, and I can say that even though they're usually in a different location, you can generally find the same information. Fidelity, Schwab, E-Trade, TD Ameritrade, IBKR, they got the same information. This way, when you guys come over and you're at the options chain, you have a lot better understanding of where things are located, how to adjust it to show you the information that you're interested in. And one last thing, I forgot to mention it while we were looking at it, but on these layouts, Thinkorswim has an indicator, probability of being in the money, probability of being out of the money, and just straight up, what's the probability of price touching this strike? If you're trying to run a stop, for an example, this would give you a really good probability of what's more likely, that I'm going to hit my target profit or that I'm going to hit my stop. It's a really good heads up, right? Or if you're building an out of the money trade, how likely is it the price can actually get to your spread out of the money? Maybe you're doing an out of the money debit spread, and you want to know how likely it is the price is even going to be able to make it that far in the time frame that you're looking at. Or you're in an out of the money put spread, and you want to know how safe you are. How likely is it the price is actually going to travel that far and get into your position? So those probability values are really handy. I'll try to get the book updated by the end of the day. I really don't think it's going to be a problem. And when I do, I will get it posted into the Discord for you guys. You'll find this video on the Bullish Bears YouTube if you were to search for Introduction to Options number 9, because we're going to get the videos to start matching the book like we did in the advanced options. And to do that, we got to jump forward in the number. What happened is I would have a class without updating the book, say like last week when we did a review. There was no updates to the book, so we had a class, but we didn't have anything added to the book, and those numbers don't match. So today we've reset things. This is part 9, video 9, Introduction to Options. All right, y'all. I will see everybody tomorrow morning. Oh, any questions? That probably would have been a good thing. Before I hit end, any questions on what we covered here today? Hey, no worries, Rock. Glad I could help, buddy. All right. So let me kill the recording.